Welcome to another episode of Inside the Margins, where we take a look at how fintechs, banks, and financial institutions manage and assess risk. Today, I have a very special guest from the European Banking Authority, Lars Overby, who's the head of risk metrics and has spent many years in the regulatory and compliance and policy specialist arena. Lars, welcome to Inside the Margins. It's great to have you with us.
Thank you very much.
You're welcome. And I want to be clear for our audience, this conversation focuses around regulatory design, risk frameworks, and implementation considerations. We're not going to be discussing any institution-specific supervision or enforcement, right? We really want to explore how risk frameworks are actually designed, how they evolve, and what risk professionals should understand about the logic behind them. And we really appreciate having the perspective from an authority such as yourselves. So, Lars, you've been at the center of European regulatory development for years. You've seen Basel reforms, CRR revisions, implementation debates, and more recently, a little bit around simplification discussions. But to start off, I want to go back a little bit. And for any of us that were working in financial services, many of us remember all too well the financial crisis of 2007, 2008. I know I was heavily in the workforce, and it was a challenging time. When you experienced that, from a framework design perspective, what core weaknesses did post-crisis regulation aim to correct after going through such a tumultuous time?
That's a very broad question, to be honest, to start with. Yeah. I think it's also one that has been a significant topic for academic research and others, so I'm not sure I can do the full justice to everything.
Of course,
but,
yes.
But I would say, I think, as always with crisis, it's not only one thing. It's a combination of many things that go wrong at the same time. I think clearly banks were undercapitalized at the time. I think compared to the risks, I think we were a little bit underestimating the kind of risk that banks were taking. So we've had to increase capital levels significantly since then. But I think that's not the only cause. I think there were also kind of, as you allude to, some design flaws, things that were not fully thought through. In general, I think how incentives work and the banks, the risks that they take, I think that was not fully understood. I think securitization was probably the best example. The US prime mortgages was also another example. But also, then there were where we had blind spots. I think the facts that the interlinkages between banks, and I think here especially the derivatives reforms, moving more to CCP clearing, moving towards bilateral margin exchanges, which was kind of putting firewalls between banks so we don't have the risk propagation, I think was also one of the key things. The last thing which I also think was clearly missing is a framework how to close banks. How do we avoid that we in a very hectic situation, we know what we're doing, we can provide the certainty to the market, how the risk is propagated, so we don't get into the systemic failures that are there. At the end of the day, the regulatory framework will never prevent banks from failing, and I think we should not also have that as a target to prevent banks from failing, but we should avoid that it becomes a systemic event. And I think that was where the great financial crisis probably differs from most of the things. So since then, I think we've spent 10 years trying to fix the issues in Basel. And I think the last 10 years we've been trying to fix things, implementing them. And I think now we are at least close to the implementation here in Europe. Other jurisdictions, including the US, is perhaps lagging a little bit behind, but I hope that they are also coming relatively soon.
Yeah, and you raise an important point that, when you think about designing regulation at the European level, there's obviously a balance between financial stability, but institutional flexibility, right? Because as you point out, you don't necessarily want to prevent systemic failure if that's the route that things are going, but you want to create that, kind of financial stability so there isn't systemic crisis. So how do you balance that? How do you think about that when you're designing regulation?
But I think that's at the key of everything. And I think if we look at the optimal framework, and I don't believe, and I say optimal in quotation mark, because I don't believe that there's one optimal framework that is. I think you have to take different account. It's clear that we've been trying to increase the risk sensitivity of the framework generally so that the banks are more aligned with the risk that they're taking. We have then backstops in the form of output floor, leverage ratio, which is kind of saying at the end of the day, there's a limit to how much risk you can take on the balance sheet, but how you take it is there. So for me, what's more important is not the amount of risk that banks take, but that they're capitalizing the type of risk that they're taking on their balance sheet adequately. And I think that's that's the key in terms of making sure that you have this. And then you avoid the kind of propagation effects that you have, the interlinkages between the banks, which is where the systemic element becomes in. And I think that's key to avoid.
Yeah, and we see that a lot in our practice where, there is some amount of risk that institutions are going to take. And to your point, are they well capitalized? Do they understand the risk? Are they doing things to help mitigate it potentially? I think are all kind of, components of a solid framework. And, you want to have some amount of resiliency and consistency, but you don't want to necessarily suffocate business models, right? As we see different business models continuing to evolve, those things I think will become important. And, you kind of point out in practice, it works in a way that there is some amount of understanding that capital allocation, if an institution is going to be taking on those additional risks. But then when you get into implementation, where do implementation challenges typically emerge? So you've developed the framework, and once that framework meets real world balance sheet, what are some of those challenges that you've experienced from an implementation standpoint?
I think the key challenge is always having a framework that everybody understands in the same way. And I think that is more important than ever, also in a European context where we have many national supervisors. We've taken one step forward with the SSM and the implementation of this. But this is still only covering the euro area large banks. We still have significant differences also among smaller banks and non-euro. But this key about having clarity on the rules is just as important as the other elements on how you actually implement this. If there is flexibility in how you implement rules, then you will end up with different implementation challenges, and you will end up with different frameworks giving different results. And I think this is also one of the things we saw in the financial crisis. I think the lack of trust to internal models was, for instance, an example on this, where we've then had to step in and provide more clarity.
Yeah, I often find, right, if the rules of the game are clearly defined, then you know kind of what box you can operate in. But as you kind of expand that flexibility, then you have the opportunity to increase risk or uncertainty, Yeah. And it leads me to think a bit about simplicity versus risk sensitivity. So we touched on this a little bit already, but I think it's an important component of, I'm sure regulators kind of deal with this on a regular basis of making things too overly complex versus having the right risk sensitivity. And obviously complexity, as I just said, it introduces potentially uncertainty and just a lot of management oversight. Why do you feel like maybe this simplicity versus the sensitivity debate is still kind of unresolved after all these years? Or do you feel like it's evolving or changing in a certain way?
I think it has always gone a little bit in circles, up and down, trying to find the right optimum over time. I think the challenge that we at the end of the day is the world is complex. It's not like banking regulation is complex on its own. It's because it captures a multitude of business models. It captures a multitude of products that all have specific risk characteristics. And I think one way of going is indeed going ever increasing in the risk sensitivity. You get something which is closer aligned to having sound incentives. Basically, you have to allocate the amount of capital that is needed to kind of protect against this. Versus having something that's simple. I think Thomas Hoenig from the FDIC back in the financial crisis proposed we just implement a 10% leverage ratio and then we're done. That's probably where you get oversimplistic, because then you give up on the incentives. Because if you have a leverage ratio, all you incentivize is taking high risk loans or high risk exposures, and then you basically penalize the lending to low risk exposures. So how to find this balance between something where you have the risk that banks are taking and the incentive to take on the risk and be rewarded on this, also in terms of having the right capital in the prudential framework, versus having something that's simple to implement and does not kill you in the implementation phase. That's where this will always wave a little bit back and forth, and we will probably have to continuously adjust. So I don't think necessarily that this newest saga on simplification will necessarily stop here. But it's just to kind of fine-tune this, finding this everlasting perfect balance, which is probably not there for all products.
Yeah, and at its core, right, regulation kind of shapes behavior, right? So we see that institutions will react or kind of make adjustments based on the regulatory environment. What incentives do different frameworks create for banks and lenders? Like, what are some of these things that they need to be thinking about?
Well, I think if you take, for instance, the output floor, has been a way of solving this kind of trust that you have on internal models, where the incentives on banks to model ever lower capital requirements on this, which at the end or at the extreme leads to a lack of trust in these models because they become more capital optimizing exercises, then you have to have a backstop at the end of the day. The output floor tells banks you can have a capital advantage of 27.5%, but once you reach that limit, you should focus more on the risk differentiation on your relative loans, which is what we want more for the sound risk management, that you differentiate between the loans rather than trying to kind of optimize the capital requirements themselves. So the output floor, again, came from this way of trying to provide incentives to focus more on sound risk modeling rather than making ever lower capital requirements. The downside on this,
Oh no, I was going to say, and I think it forces the ability or the requirement to kind of stitch all of these things together rather than have them as disparate systems, right? Yeah.
But I think then on the downside with the output floor, we are now seeing a very high focus on the standardized approach. Large banks have not been using the standardized approach because they've been using internal models. And now they put much more emphasis on the implementation. And clearly then they will realize that the standardized approach is not as risk sensitive. This is less perfect. It will not capture. It's a more simplistic way of the world. And that means that the risk sensitivity, which means that some exposures may be penalized more than others. And then we get into a different set of issues where we've now moved to probably focusing more on the standardized approaches through the output floor implementation.
Yeah, interesting. And you alluded to kind of the implementation challenges that many institutions have to think about, right? Whether it is the standardized approach or more complex internal kind of efforts. Where do you feel like because this is obviously part of the cost benefit that they have to figure out for themselves, right? So where do institutions often struggle when implementing these complex risk frameworks?
I think at the end of the day, it's a question more for the banks, but at least what we are hearing is, I think one of the challenges is on internal capital allocation. So in a world where you have only the standardized approach or the internal models, it's very easy to internally capital allocate. You get an outcome on this and you can use that as a key for your capital allocation, your return on equity or cost of capital and use that and calculate. In a world, for instance, with the output floor, this becomes more complex because if you're then restrained by the output floor, how do you then allocate that constraint to all of the products that are in your portfolio? That becomes quite a key issue in terms of how you also get the optimal kind of cost benefit returns on your returns on your assets. And I think that is a key change compared to what we've seen in the past. This kind of incentives, this internal capital allocation is probably where there is a big debate internally in the banks to figure out how are they dealing with that. This is less in the prudential framework, but it's a direct consequence of the prudential framework. And if things like that, where incentives has probably changed as a consequence of this, and I think we also as regulators need to look at and see are we ultimately ending in a better place, or should we even simplify further and then say less risk sensitivity, but making sure that there are, let's say, not as many incentives to kind of tweak the systems here and there. That I see as one of the key challenges that is facing us on the regulatory side.
And do you feel, on the institution side, do you think there is as they contemplate these things, I would think some of the assessment even is, do we have the internal capabilities? Do we have the internal data structures? Do we have, that has to be part of the the consideration, right? Of like governance, model validation, internal, there's so many components when you think about what's required to be able to do these things successfully. Do you think that's part of the overall cost benefit?
I think clearly banks have to think about what they're investing in and also where they're putting in their resources. I will say, I don't feel bad as a regulator to push banks to invest in data infrastructure and being better at their risk management. It's clearly a cost, but the world is moving in a direction where data is going to be the commodity. So that banks are thinking about how to optimize their internal processes to get data structures in order and be able to use this. That I don't see as a bad thing. That I see as a positive thing and can only be positive also for risk management.
Yeah, I completely agree. And again, like a lot of the customers that we consult with, we face, they have these same challenges and understanding what data they need, where, how should they structure it, the reporting, all of the things that these are all kind of core components of solid risk management, whether you're talking about how you manage your overall portfolio or capital allocation and ensuring that they all tie together, correctly. Right. So I think the reporting architecture, data definitions, all of these things really become a really important part of this infrastructure layer. And I think what I've seen over the last number of years is institutions are willing to invest in those things as long as they kind of understand how it will kind of tie to the outcomes they're driving towards. When, do you think that there's ever a point at which like the guidance and the complexity can almost turn into operational burden? I mean, have you seen it yourself in practice where, it actually becomes detrimental, or do you feel like it's just so fundamental and foundational to the risk infrastructure that it needs to be done?
So I think the challenges, and I think this is one of the challenges that we've been facing generally in the reporting area, that it's clear that banks are facing reporting from many different channels and with high frequency. And I think one of the things is probably that on the regulatory side, we need to provide a little bit more stability in the data requirements that we are asking from the banks. So I'm not saying that there are not things that cannot be done. It's clear in a European context, we have the ECB who needs data for their supervision. We have data for risk management, but we also have SRB, which needs data for resolution of banks. And they are all the same, but slightly different. And I think this is one of the areas where in terms of having common definitions and things like this is key. And I think here we, on the regulatory side, on the reporting side, we have to push on this. And I think this is one of the focus areas for us. I will also say that we've also been trying to do a lot to kind of get transparency around the data. I think as a blatant commercial for what EBA has done, we've been publishing our so-called Pillar 3 hub, which basically allows anybody to go in and see all of the Pillar 3 disclosures and compare them across the banks. So there's also an element of market discipline that you have comparable numbers, that you are able to compare your banks to see what is the risk that the different banks are taking. And things like this on definitions, on predictability in the reporting requirements, all of these things are things that we can improve on. But I will also say, I come from originally from a bank coding in COBOL 66. And this was in the early 2000s where this was definitely not in vogue anymore. No. It's also clear that banks have been struggling to update legacy systems. I don't think we are in COBOL 60 anymore, but we are nonetheless have legacy systems that are perhaps fragmented across. And I do think that banks who invest in a common data structure that can be used across prudential requirements and so forth, I think this is important.
Yeah, I would agree. And we are starting to see, so we experience much the same in the US, and I've seen it with some of the UK and European companies that I've had discussions with about these exact topics. And one of the things that I'm seeing in the US is there are companies that are trying to help solve this problem of creating a common and standardized underlying data warehouse structure. And I look forward to, the potential that it can bring to allow, because to your point, for many institutions, these legacy systems are all over the place. They don't talk to each other. They're not connected. It often takes, I grew up doing SAS coding, so I was a little bit past COBOL, but, the same concept, right, is we would often have to stitch information together across a bunch of different systems to create an effective view of what was going on. And, I think there is opportunity for institutions to upgrade what they're doing. And nowadays the technology kind of allows for that flexibility. So as regulators kind of create that transparency and standardization, it does make sense that there's probably going to be a convergence of capability on the banking side and technology side that meets where the regulators want to go. And I think there could probably be some really great things that come out of that effort, So,
but because in a very optimal world, you would have reporting on a loan by loan basis, and you'd be able to have characteristics that would be able to aggregate to any kind of characteristic. But it's very clear that then you need aggregation variables, which will run in the hundreds to be able to use it for all kinds of things. And then you also create something that's complex. But in its very extreme, then you have the optimal data structure. There are then challenges to implement this, but there are things like that where there are things can be optimized. And I will also say on the regulatory side, and this is perhaps more going back to the pre-crisis work, the push for internal models was also to require banks to invest in their risk management. And I think that requirement has not gone away. Banks still have to invest in their risk management. I think these days it's more data and being able to do this, rather than perhaps catch up to the newest methods on whether you use expected shortfall or VAR measures and these kind of things, but be able to have data to be able to measure risks, figure out whether there are correlations that you've missed in your data across your clients. Elements like this, I think we still have to provide incentives for banks to continue investing in their risk management. And that also requires investing in their data.
Yeah, very much so. And it's just good business practice at the end of the day, right? I mean, they will benefit from those investments and doing those things, and then hopefully meet, those regulatory requirements, right? I want to pivot a little bit. So kind of thinking about the future direction of regulatory risk frameworks and where we're heading. From your perspective, what themes are kind of shaping that next phase? So we touched a bit on the data and reporting and start trying to get, some clarity there. But in Europe, what do you think this next phase of regulatory risk frameworks look like?
I think it's clear that the European debate is very much about simplification. I think the Commission came out with a consultation paper last week on the competitiveness of the European banking sector. And I think the general tone is, have we gone too far in terms of introducing something that's too complex? And I think, to be fair, what I'm hearing more for the banks is not necessarily the individual rules themselves that are complex. It's the whole, in terms of having an overview on this and finding a way to kind of simplify things, I think would be welcome on all sides, both our sides, but also supervisors and banks who are able to do this. The problem is this also comes as a cost, as we've discussed before, because you can simplify things and I can make very simple rules, which are less risk sensitive, and how to find the balance between these different parts. That's not going to be easy, finding a new balance or a new equilibrium where we are then changing to something that's simpler, but perhaps less risk sensitive. So I think that's where the debate is going. But what we'll be able to do, and then see whether we are also agreeing at the end of the day with the industry, which probably would prefer to have lower capital requirements on some elements, where we as regulators are more comfortable with the level of capital that is in the system right now.
Well, and to that point, so how do institutions think about potentially that simplification path without losing their risk discipline, right? Because there's still a need, I think, whether, even if the rules are simple, they still need to have that risk discipline in place. So how do they think about that?
I think that is the key. And I think then we go back to this discussion about incentives again. I think mortgages is a very good example. I think mortgage is a low risk product, and you can have that, and you should make sure that you have the incentives to still issue mortgages, even if it's a low risk product. But if I were to simplify rules, I couldn't necessarily tell you how I would simplify the framework for mortgages, because we have a framework which calculates LTVs and uses this as a risk metric. You can have something that's simpler, but then you lose the kind of risk sensitivity in the framework. And that I'm not fully convinced is the way to go. So I think that's also why the Commission consultation paper, I think, will be the opportunity for the industry to say, what do we need to look at now? And what are the elements that we as supervisors and regulators have to focus on?
So if I like thinking about it from an institution standpoint, right, as we move towards this kind of future state, And there's the potential for simplification, but also maintaining that risk discipline and understanding what the regulators are looking for. What are the things I should be thinking about over the next, say, 5 years? Is it data science, governance design, regulatory literacy, staying close to the regulators to understand what they need? What do you think, if I'm sitting in the institution seat, how do I need to think about the next couple years?
Again, issue number one is certainly you need to invest in your data. You need to be able to show and demonstrate that your risk management practices are up to scratch and that you're focusing on having sound infrastructure on your data side and be able to use this optimally. I think regardless of what direction the regulatory framework is going to take, the use of data and being able to understand this better going into the world of AI and machine learning, I think will require massive amount of data, and being able to have a infrastructure that supports that is key. Then I also think you need to invest generally in the risk management to kind of make sure that you spend the time to focus on identification of new risks on the balance sheet and generally be state of the art in terms of what you're doing there. And I think then the interaction with the regulatory framework is then always going to be there. We've always seen that the regulatory framework will lag behind on the newest risk management method, and that is only natural. We cannot implement them immediately. But once you have established practices, then they also get implemented in the regulatory framework. So there's always going to be a back and forth interaction with implementation of new risk methods, identification of new risk, and then the regulatory framework will also have to evolve there. Basically seeing, do we need more guidance on how you use, let's say, AI, machine learning models in your pricing algorithms? What is the black box risk that is arising by using these algorithms? Can we find ways to quantify this? Can we find ways to minimize this? I think it's there the challenges will be. So I think perhaps having had a long career, which means I'm old now, also means that the focus is more on there will be new things, and you need to have the ability to adapt in your business models and use the new methods that are coming out. And then the regulatory framework will also catch up, eventually providing guidance on these elements. The key will just be right now how to find this in a way that you're not stifling innovation in the banks while having something that maintains sound banking sector that avoids the financial stability issues that we saw in the financial crisis.
Yeah, it's interesting that we're seeing AI and obviously we've been using machine learning for a long time, but the advanced techniques, the black box methodologies, AI is kind of coming through everywhere, and I think it'll be really important for lenders to be thoughtful about where they implement these tools, how they use them, what parts of their I can see where there's operational gains, but just utilizing some of these new tools in and of itself introduces risk, right? So there needs to be good governance and oversight of these things as banks look to implement them. So I'll be curious to see kind of where things continue to evolve over the coming years. But also, as you point out, not stifling innovation is key, because I think that, there's opportunity to serve maybe underbanked communities, underserved consumers. There's areas that gains can be made with these new tools. So final thought, if you could leave senior risk leaders with one insight about regulatory design, what would you want them to better understand?
I think often when we discuss with banks and general associations, you end up in very technical discussions on one little corner of the framework on whether the risk sensitivity is optimal in this framework or not. What we're thinking about is generally more about what is the incentives that you're providing on using this. This be it, I think one example is indeed in these internal models. If you incentivize banks to model and invest in internal models, but you don't provide any backstops in terms of how to make the risk differentiation, then you get into problems. Another area that we've seen is clearly in securitization. I think we're trying now to loosen a little bit now in the securitization framework in EU. But if you end up with a framework that does not implement the elements that caused the financial crisis, make sure namely that those that are issuing the securitization have skin in the game. If you do not have proper transfer of the risks that is taking place, then regardless of what you do on the capital requirement, then you are setting up false incentives or wrong incentives. And this part about the incentives and taking the broader picture, I think sometimes it's a little bit lost when you end up going into a little bit detail, being on whether you've introduced the materiality threshold on definition of default in our guideline, or how to calculate a very specific element in your standardized approach. And having this broad picture and being able to sell this to the underlying risk, I think that's the key.
Well, Lars, this has been an incredibly insightful and valuable discussion. I think for many risk professionals, when they get into regulatory complexity, it can sometimes create frustration. But the reality is, and you've so eloquently pointed out, that frameworks are really built around incentive structures and stability and long-term resilience. And I think it's a good reminder that we have these things in place for a reason. And it really, at the end of the day, ends up being good business practice, but also creates soundness in the system. So I want to thank you for joining us on Inside the Margins, and I appreciate your time.
Thank you very much.